All right, so the Russell 2000 has given up all its gains for the entire year. So what does that mean? Is it time to buy, or should you keep on selling and selling? Today we've got Craig Johnson and Chad Morganlander here on Trading Nation to discuss. Craig, I want to start with you. When you look at the charts, what do they tell you?
Well, when we look at the chart, what we've been seeing for the Russell 2000 is at the very lower end of the range, you're at about 1340. It's kind of the lower end of the trading range since about November of last year. And at the upper end of the range is about 1415. All we've done is consolidate sideways. So initially, small mid-cap stocks had a pretty good push higher post the election last year. But since a lot of things have not been done, we've been seeing some weakness in the overall dollar index. We've been actually seeing larger cap stocks outperforming mid-small cap stocks. And at this point in time, it looks like we got a little bit more downside to that kind of 1340-ish level. And I suspect that retest is going to take place. I'd also just note that kind of the best way to answer the question that you posed to us today is, do you sell your small mid-cap stocks and go large cap? Well, I like to look at a ratio chart, meaning take a chart of the Russell 1000 divided by the Russell 3000, and what you'll see right now is that it suggests that large cap stocks are still gaining on a relative basis against mid-small, and because of that, I'm going to stay with the large caps right now. I'm not going to try to rotate into small mid-cap stocks quite yet, not until I see a change in that relative performance chart.
Chad, what do you think about that? Are you sticking with this trend?
I completely agree with Craig. We would go with large cap, stick with large cap growth for the time being. We do, though, we're a little bit more cautious on the overall market. Small caps historically have a lot more beta than large caps, so we would move up the quality spectrum. From a valuation perspective, if forward-looking 20 multiple, a little too rich for our blood as well. It looks as if a couple of reasons why we're getting a little bit more pessimistic. We went from an overweight to a neutral based off of our short-term barometer. It looks as if risk is going to be more elevated over the next 3 to 6 months. Two, you have also monetary policy here in the United States, but more importantly by the ECB, that looks as if it's going to be readjusted over the course of the next 6 months.
So what do I do here if you guys both agree? Then this is not much of a debate, right? So I feel like I should just take the other side and disagree with both of you. I don't know. Because when I look at the charts, I just think to myself, all right, you know, most of my investments are basically S&P based, large caps, and I look at that and I think maybe I should swap out. Maybe I should sell S&P, get into Russell because there's some relative value there. But maybe one of you explain to me why that's just not the move to make.
Well, from my perspective, I would not make that move yet because as you think about the relative performance right now, it's still being driven by the large cap names. It still seems too early to suggest that these small mid-cap stocks are going to get done. If we had more certainty in Washington, you know, from a fundamental perspective, and that we could see some tax cuts get layered into the economy, then these small mid-cap stocks would probably get a pretty good advance higher. But right now, that seems a long ways off from getting actually accomplished. And so for me, I like to see the weight of the evidence, and I like to see it in the charts. And right now, the charts still, as Chad had said, suggest being overweight large cap names and overweight the growth aspect of the market too.
All right, and Chad, final word. Do you think Washington's got any influence on this relative trade between large cap and small cap?
Yeah, it would if there was a terrific fiscal stimulus plan as well as a major tax cut, which would blow out the deficit and create escape velocity and great economic growth. But the likelihood of that is very low going into 2018. So we would actually stay with rising dividend companies, the steady Eddie type of companies, big companies that are growing steadily, increasing their dividend, that don't have a lot of debt. That, I think, is the way to play the market cycle for the next 6, 9, and 12 months.
All right, Chad, Craig, thanks for joining us here. We'll see if you guys are right in the next few months, and then we'll have you back on to see how that turned out. Thanks for watching Trading Nation. I'm Eric Chemi. We'll see you next time.